Hey, how's it going, guys? Welcome back to another episode of Weekly Market Update. Crazy earnings season just started. We do have a lot of things to talk about this week. In this video, I will do a quick update on the US equity market, a detailed analysis on Netflix second quarter earnings, and also I will share with you guys an extremely dangerous warning signal that came from the four major banks' earning reports this week. So please make sure you watch the video to the end and do not miss out anything. I promise you I will make it quick and don't waste your time. Alright, let's get started. S&P 500 was up 1.25% this week. In my last weekly market update video, I mentioned that in order to confirm this breakout from 78 Fibonacci level and also the strong resistance level, we need to see a follow-through week. And this week, we got exactly the type of follow-through week we're looking for. We tested the 3100 level, find the support, close higher than the previous week, and also the volume is higher. This is definitely a very bullish sign for the US equity market, especially for the first week of the worst earnings season in the history, which I will talk about later in this video. This follow-through week definitely shows us that despite the worst earning estimate for the second quarter, there is still a lot of confidence in the stock market. So right now, what I'm looking at on S&P 500 is this new short-term framework for the rest of July. On the daily chart, S&P 500 has formed a very bullish cup and handle pattern, and it seems about to break out from this 5-month pattern, try to fill up this gap, and then retest the all-time high. Especially on top of that, the dollar continues its downtrend and a weakening. A weaker dollar definitely favors the stocks. So the entire short-term setup for the US equity market looks very bullish. For the coming 1 to 2 weeks, I will be watching this potential breakout on S&P 500 and keep you guys updated. Of course, the biggest news this week is the start of the 2020 second quarter earnings season. Usually, the first 2 weeks can give us a pretty good preview of how the reality meets the investors' expectations. As I mentioned last week, the overall forecast for the second quarter earnings is the worst in our history. Investors certainly expect the numbers will not be pretty. But within the worst earning estimate of our history, it doesn't mean that every single company is expected to have terrible earning report. There is actually a pretty extreme dichotomy between two large groups of companies with completely different earning outlooks. And this is one of the things I really want to touch on today to share with you guys how to navigate this extremely dangerous earnings season more effectively. So what are these two dichotomy groups? Due to the COVID-19 pandemic, we have one group that is hurt extremely bad, either hurt by the lockdown or by the extreme monetary policies. For example, the airlines, the hotels, and of course the major banks due to the zero interest rate policy plus the strict share buyback restrictions. On the other hand, we also see another group of companies who actually benefited from this lockdown. For example, the online streaming companies like Netflix, video companies like Activision Blizzard, and of course the online retail companies like Amazon, and many, many more. Because of this extreme economic shock that creates such expectation differences among all those companies, there will be a lot of overreacting and mispricing during this very special earnings season. And that is exactly where the opportunities are. So understanding this extreme earning outlook dichotomy is the most important key to help us navigate this very special earnings season. Not only it can help us understand what has already been priced into the company's stock price, but also what are the potential opportunities or the risk moving forward. During this week, the very first week of the entire earnings season, we have already witnessed this extreme dichotomy has been playing out perfectly, from the major banks' earnings and the Netflix earnings. In this video, I will mainly focus on Netflix and hopefully use my thinking process on Netflix to help you guys navigate this very volatile earnings season with more confidence. If you look at the Netflix earnings report, it looks fantastic. During the worst economy since the 1930s, Netflix was able to add more than 10 million subscribers compared with last year's second quarter's 2.7 million. Revenues grew 25% year over year, and most impressively, the earnings grew 165% from 60 cents per share to $1.59 per share. These are great numbers. But why did Netflix stock crash more than 10% right after the earnings were announced? The reason is very simple, because Netflix belongs to the second dichotomy group. And let me explain much more details. Netflix is one of those companies that are hugely benefited from this economic lockdown. When people are stuck at home with the stimulus checks coming every week, of course, one of the most popular ways to kill the time is to binge watching on Netflix. There has never been a time in my lifetime, probably in your lifetime too, that there are 4 billion people around the world has been locked at home for 2 months without going out. What this extraordinary time did to Netflix is perfectly showing on this chart. For the past 4 years, from 2016 to 2019, these 4 lines are showing us this is exactly how the normal trajectory of the revenue growth for Netflix looks like. And this year in 2020, as we can see, before the March global lockdown, the revenue trajectory follows pretty much the same as the past 4 years. But right after the lockdown, we see this huge spike on the membership revenues. And that certainly tells us Netflix was gaining a huge benefit from this COVID-19 lockdown. And that is why we're seeing their stock price has rallied almost 100% since the March low. This crazy rally has fully priced in the expectations that Netflix will have a great second quarter earning result and also sustain the average growth rate of the past 4 years. And this is where the tricky part comes in. Because of this global lockdown, a lot of Netflix future potential subscribers already became their current subscribers within the past 3 months. So that creates a big problem for Netflix to maintain the original growth curve. In other words, a lot of potential new subscribers from Q3 and Q4 already became the subscribers in the Q2. That is why we're seeing the forecast for the next quarter is extremely low, only 2.5 million new subscribers compared with last year's 6.8 million. Also, this much lower than average performance will continue for at least 2 quarters for the rest of 2020. And that caused a big stock price correction on Friday right after the earnings were announced because investors start getting a little bit worried about Netflix's future growth potential. So right now, you probably have 2 questions. First, is it a good time to buy Netflix right after the Friday's correction? Second, what can we learn from Netflix's earnings report and the market reaction? And can we get any valuable clues on what is going to happen to other similar companies in the coming weeks? I will start with the first question. To know if it is a good time to buy Netflix, I like to use the high growth stock valuation model and calculate the fair value price based on the company's earning growth estimates. Currently, the Wall Street analysts believe that for the next 5 years, Netflix's average annual earning growth will be around 36%. So, if Netflix can grow at such a rate from now until 2024, the fair value price to buy Netflix today is $486, which is very, very close to Friday's closing price. What this valuation model tells us is that if you believe Netflix can grow 36% a year, then right now it is a good time to buy some Netflix shares because it's around the fair value price. If you do not believe Netflix can grow 36% a year, then the current price is definitely overvalued. In my opinion, 36% a year is a very conservative estimation for companies like Netflix. And I do believe around $480 is a very good place to add some Netflix positions. We might have further corrections for the short term, but for the long term, I do believe in Netflix and the online streaming business in general, especially after we all have been through during this COVID-19 crisis. In the future, I will definitely make a video to talk about why I am very bullish on online streaming businesses, especially combined with the AI, the cloud computing, and the 5G technology. Alright, second question. Can we get any valuable clues on what is going to happen to other companies in the coming weeks from Netflix earnings? The answer is yes, absolutely. For those companies who gain a huge benefit from this COVID crisis, for example, like these 4 companies, we should expect at least 2 things. First, their earning numbers should be exceptionally great in the second quarter. However, all of these great expectations and the potential results have already been priced into their current price. So please do not try to gamble on their earning results. There's not much upside for you to gain, but there's a huge downside risk just like Netflix if they just miss a little bit of investors' estimates. The second thing we should expect is that, similar to Netflix, the exceptionally great second quarter result and growth can cause a big disappointing outlook on the next 2 quarters for the rest of the year 2020. If the market overreacts to such disappointing future guidance, then it can potentially give us great buy opportunities right after the corrections. Alright, before we go, I just want to touch on one very, very important risk signal that came from the major banks' earnings this week. This chart shows the amount of bank loan reserves for each quarter from the 4 major banks that have announced their second quarter earnings. As we can see, in the first 2 quarters of 2020, all these 4 major banks have increased their loan loss reserves to the highest level in their history. Bank loan reserves are also known as the bank loan loss provisions. Issuing loans and making profits on the interest is one of the bank's major businesses. Typically, banks need to reserve some cash to prepare some of the clients who might go default, go bankrupt, and not able to pay back their loans. These include both individual loans and the business loans. Usually the amount of loan loss reserves is pretty small because banks don't want to hold too much cash and waste the opportunities to make more profits. But when the banks believe the economy is going to get really bad, they will usually increase their loan loss reserves. And now we're seeing an extremely high level of loan reserves in all these 4 major banks in the US for 2 quarters in a row. It never happened in our history before, not even back in the '08 global financial crisis. So this is definitely a warning sign to our economy in the near future. The only reason banks are increasing their loan loss reserves at such insanely high levels is because they're preparing for the worst. They're anticipating there will be a large amount of businesses and individuals will go bankrupt in the near future and won't be able to fulfill their loan payment. Will this be the beginning of the next insolvency crisis of our market? It's still too early to tell, but the major banks in the US are already preparing for the worst, and that definitely deserves all of our attention. Alright, that will be the end of this video. If you are new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market, and also what are the trade ideas or what investment opportunities that you should pay attention to in the market. If you are interested in the world of finance and business and find my videos being valuable to you, please consider subscribing. Thanks so much for watching, guys, and I'll see you guys soon.